let's talk about another story that we're watching here this morning that's sort of in line with some of the spending trends we're talking about. RH, the luxury furniture retailer, formerly known as Restoration Hardware. The stock is down 8.5% after cutting its outlook. It cited lower than expected demand. By the way, it didn't just cut its outlook. It cut its outlook for the second time in a month?
Mm-hmm. We just talked about this company a couple weeks ago for earnings.
So the company now says for the full year, its revenue will fall to between 2 and it will fall. It's not going to grow at all. It said it will fall by 2 to 5%. It had seen flat to up 2% growth just on June 2nd. That was the most current number that we had. It sees adjusted operating margin at 21 to 22%. It saw 23 to 24%. And the company's chairman and CEO saying in the statement, basically it's a deteriorating macroeconomic environment. Another interesting side note in the statement, they had just announced a stock buyback, but they haven't actually bought back any shares yet, even though the stock has been under pressure.
RH was the tell. Months ago, RH started warning about pressured demand trends in their business. Everybody shook it off, but really that has been the canary in the coal mine stock, canary in the coal mine company. I'm looking at a good note from Citi analyst Steven Zaccone on RH. Apparently, he caught up with their management team after the warning last night, noting two things. One, they are not going to promote. This is a company that is not going to discount prices like Target to move really the high levels of inventory that we just saw from them a couple of weeks ago. And the last two, they view, or according to Citi, that 20% is still seen as the operating margin floor. So that was interesting nugget as well.
Also interesting here, how much of their actual new sales are really tied to the luxury homes market as well. Friedman also noting with mortgage rates double last year's level, luxury home sales down 18%. That impacts this business's ability to sell into some of those new homes, people who are furnishing those luxury homes and the 18-bedroom type of situations that people may have been buying into previously. They're also talking about the Federal Reserve's forecast for another 175 basis point increase to the Fed funds rate by the year end. Their expectation that demand will continue to slow throughout the year.
Hey, look at me. I mean, I'm buying fewer RH tables. I mean, things are getting tough out there.
I'm buying fewer luxury homes.
So let's talk about the bigger picture also, because as you and I noted last week, Lazy Boy somehow is still doing well, right? But then on the flip side, you have all of these signs lining up. Target saying it's seeing weakness in its home goods category. Along with RH this morning, we're seeing the likes of Wayfair,
Walmart too,
Williams-Sonoma,
Walmart
right?
Too.
So there does seem to be, maybe with Lazy Boy accepted, a lot of weakness in this home furnishings category, which again, what's so interesting about this period of time for me is we knew what was happening during the pandemic, that there was a pull forward of all of this demand. Everyone's spending time in their homes, And yet, and we talked even at that time, this will not last. And yet it's still somehow surprising that it's not lasting,
right?
It's
the numbers. It's the numbers and, the frequency.
It's the velocity. Yes. It's the speed with which we are seeing this happen. It's the depth of that.
It is not normal for a company to report earnings and then 3 weeks later come out and warn. And that is two retailers we've now seen that from, RH and Target. Huge red flag.
It also begs the question of for all of the people that were using some of the historically low mortgage rates to be able to buy into a vacation home, are they just going to say, yeah, we'll sit on the property for a little bit and then we'll figure out, do we need to furnish it later on? But it won't be Restoration Hardware, at least for right now.